What's going on, everyone? I got an awesome video for you guys today. It's kind of funny I say that for every video because they are all awesome. This video, we're talking about, what are we talking about? What to look for when looking at a bid-ask spread. So a lot of you are interested in going out and buying stocks that are companies that you might use their products every day, like Snapchat, Facebook, or Google, or just stocks that you heard are going to go into the stratosphere and everyone's going to make a lot of money from them. Fair warning though, depending on the bid-ask spread of the stock, you could be setting yourself up for a big-time disappointment and, more importantly, unfortunately, some big-time losses. We're going to go in this video, we're going to talk about a few scenarios where if you're not knowing what you're doing, if you don't understand the bid-ask spread before you go ahead and buy a stock, you could lose tens of thousands of dollars in a given year. So make sure you pay attention, guys. This is going to save you a lot of money in the long run. A lot of money in the long run. I promise you, we're going to give you a nice, actionable takeaway at the end of this video. So strap on. We're going to get inside of the computer. We're talking about stock bid-ask spreads. Okay, YouTubers, we are back inside the computer. And we're talking today about something that actually every single person that's made any type of investment by themselves, meaning any single person that has gone into an online brokerage account and actually placed some sort of investment or trade in a stock themselves, they've actually touched what we're going to talk about today. And that is the stock bid-ask spread. So the title of what we're talking about today is what to look for when looking at a stock's bid-ask spread. Now, most people who are tuning into this video didn't know or don't think there's anything to actually look about. You have a bid and the ask and you just buy it because stocks go up, right? Well, that isn't always the case. The reality is in the stock market, there are a lot of things that we don't have any control over. What a stock does, what goes on in the world, who the president is, what the Federal Reserve is doing. We really don't have any control at all over any of that. However, something like knowing what to do when we look at a stock bid-ask spread is something we have 100% control over. And the things that we have control over in the stock market, we want to make sure we are setting ourselves up for success. There's only a few things. There aren't so many things out there that we have control over. But everything that we have control over, we want to do to the best of our abilities, and we want to do it the right way when it comes to the stock market so that we can set ourselves up for success so that when stocks go our way, or when the strategies go our way, and when positions go our way, we maximize the amount of money we can make. And at the same time, if the stock does not go our way, if the positions don't go our way, if the strategy we use wasn't the right strategy, we won't lose more money than we normally would. So the reality is, and to me, knowing what to do when looking at a stock's bid-ask spread is actually a big-time money saver, and we'll go into exactly why here in a little bit. But the reality is, again, guys, with a lot of these videos, something very simple, something that you've probably looked at before in your life, is actually probably losing you a lot of money unless you know what you're looking at. So the truth is, how are you going to grow your account without some sort of a game plan? So we're going to come up with a game plan of what to do when we look at a stock bid-ask spread here. This should be an exciting one. It's going to be super informative, and there's going to be a nice actionable takeaway at the end of this video. So the bid and the ask. Right here, we're looking at the bid and the ask of SPY. SPY is the S&P 500 Index ETF. It is an ETF that tracks the exact same price movements as the S&P 500 Index at just 1/10 of the price. And we can see here we have a bid of $266.08 and an ask of $266.09. So, what is the bid? Simply put, the bid is the highest price someone is willing to pay. So right now, or in this image in SPY, the most someone is willing to pay is $266.08. On the other side, the ask is the lowest someone is willing to sell for. The least amount of money that someone is willing to sell any shares of SPY for right now, looking at this image, is $266.09. That's what the bid and the ask are. The bid is the most someone is willing to pay for, and the ask is the lowest someone is willing to sell for. That is the bid ask. and the spread is the distance between them. Let me repeat that. The bid is the most amount of money somebody is willing to pay. The ask is the lowest amount of money someone is willing to sell for. And the spread is the distance between them. Pretty simple. Now, why does this matter? And right now we're looking at a spread of Google. We're looking at the bid-ask spread in Google. The bid, $1,052.71. The ask, $1,053.21. So why does this all matter? What's the big deal? You just buy the stock and it goes up, right? When the bid and the ask are further away from each other, there is less competition for shares, thus less opportunity to get executed at the best prices. So if we look at something like SPY, if you were to go ahead and buy SPY, you could go ahead and put in a buy order, and more than likely you would get filled right at the ask, 266.09. Right? The mid price is 266.085, and that's actually something that you can't put an order in for. You have to put it in at either 08 or 09. But if we look here at Google, we see a 50-cent wide spread. And the mid price of that is, let's see, quickly 25. So the mid spread of that is, I don't know, 25 up. So let's see, it is 1052.96. That is the mid price between the two. But with the 50-cent bid and ask spread, it is far less likely that you will get filled at that mid price, which again is 1052.96. It is far less likely that you will get filled at that mid price because there's less competition for these shares. Now again, sometimes we can get executed at mid price, which is the mark value, which again is the mark value between the bid and the ask. The bid right here, 1052.71. The ask, 1053.21. That is a 50-cent wide bid-ask spread, meaning the mid price is 1052.96. Right, so the wider the bid-ask spread, the less likely we are to get filled at mid price, which again is no good. Now, like most of the videos we do on this channel, we take what we see, we take what we hear, we take what we think we know, and we put numbers toward it so that we can have reasonable expectations of what the numbers say, of what the math says, as opposed to what somebody else in financial media investment education says. So what we did was there was a study done in 2006 by BATS. So BATS is the CBOE Equities Exchange, Chicago Board of Exchange. They facilitate a large part of the equity trades that go on from a day to day. So there was a study that they did in 2016 where they looked at the average fill price in comparison to the average bid-ask spread broken down by the bid-ask spread in a random sampling of S&P 500 equities. So that's a little bit of a mouthful. Why don't I just show you what happened and then we can talk about it. So what you see here is we see random fills, their distance away from the mid price of the bid-ask spread. So in the first row, we see bid-ask spreads of 2 cents and below. And the average fill price was less than a penny away from mid price. So if we had a 2 cent wide bid-ask spread, the mid price would be 1 cent. And the average fill, the average distance away from mid-price that a fill was made was less than a penny wide. If we go a little bit further, the bid-ask spread being 3 cents to 7 cents wide, the average fill was about 1.5 cents away from mid-price. Now we get a little bit bigger, 8 cents to 15 cents wide on the bid-ask spread. The average distance away from mid-price that a fill was made was about 6 cents wide. 16 cents to 30 cents gets a little bit bigger. 16 cents wide to 30 cent wide bid-ask spreads. There's about an 8 cent on average fill away from mid-price. 31 cents to 50, it gets up to 14 cents away from mid-price on average, and 51 cents to $1, which is what we just saw with the example of Google. There's about a 38 cents on average distance away from mid-price. Now, a lot of you are saying, so what? That doesn't matter. Well, let's actually put that into context. Let's see what that actually looks like. Usually, orders start at $100 at 100 shares. Usually orders start at 100 shares. So if we break that down, we can start really putting it into context as far as how much money we are giving up depending on the stock we're trading's bid-ask spread. So if we were to buy 100 shares of a stock, that's 2 cents or less the bid-ask spread. On average, we would only be giving up 30 cents per 100 shares. Very reasonable. If we were to buy 100 shares of a stock that has a 3 cent to 7 cent wide bid-ask spread, on average per 100 shares, we'd only be giving up about $1.50. Now here's where it starts to get a little bit larger. If there's a bid-ask spread in a stock 8 cents to 15 cents wide per 100 shares, we usually give about $6. 16 cents to 30 cent wide bid-ask spreads for 100 shares is $8. 31 cents to 50 cents wide bid-ask spread, about $14. And finally, 51 cents to $1, we typically are giving up $38 per 100 shares we trade. Now, here's why this is important. Again, there are only so many things in the stock market we can control. This is one of them. We can control how much of a loss we have to take just to execute a trade. So, if we look at a stock like Google, like we just showed, let me go back a little bit. Like Google, that's 50 cents wide. The study says, on average, if we were to buy 100 shares of Google and they have a bid-ask spread of 50 cents wide, right? So that would be right here. We would be giving up $14 per every 100 shares. That would mean we would have to be taking a $14 loss just to enter the trade. That is something that we can control. That is like saying, yes, I am willingly taking a $14 loss per every 100 shares just to enter the trade. Let's take it a step further. Here's what it looks like when we actually think about trading outside of 100 shares. So what we have on the left side of this chart is what we just talked about. But on the right side of this chart, starting in column 4, 5, and 6, we're talking about what if you traded stocks with these bid-ask spreads once a week, 5 times a week, and 10 times a week. And we're doing a round trip. So 1 trade a week is a buy and sell. 5 trades a week is 5 buys and 5 sells. 10 trades a week, 10 buys, 10 sells. Kind of getting a tongue twister there. And this is what it actually looks like per week, extrapolated over the course of a full year. So when I look at this, we'll skip over the first row because that's only that is a really awesome thing. But once we get to trading stocks that have a 3 cent to 7 cent wide bid-ask spread, and on average we trade 100 shares in every single trade at 1 trade a week, open and close, over the course of a year, that is an $156 loss just to enter the positions. If we ramp it up to 10 trades a week in stocks that have bid-ask spreads of 3 cents to 7 cents wide, that is a $1,500 loss against our portfolio over the course of a year. Now, it gets exponentially worse once we get wider with the bid-ask spreads. 8 cents wide to 15 cents wide. If we're doing 5 trades a week of 100 shares, open and close, in stocks that have bid-ask spreads of 8 cents wide to 15 cents wide. Again, the study done by the BATS Exchange says, on average, we are getting filled 6 cents away from mid-price. If we did 5 trades a week, open and close, on average, we would be giving up $60 a week just to execute the order and over $3,000 per year. Remember again, guys, in the stock market, there are only so many things that we have control over. This is one of them. Would you like to give up $3,000 plus just to enter the trades? That's right, giving yourself a $3,000 loss just to enter the trade. If you have a $100,000 portfolio, which is a big portfolio, most people watching this video, most people on this channel don't have a six-figure portfolio. But if you did have a $100,000 portfolio and you chose to do 5 trades a week in stocks that have bid-ask spreads of 8 cents to 15 cents wide, you would have lost 3% of your portfolio just to enter the trades. That is some nasty stuff. And let's look at the worst case scenario, which is far more likely than you think. The worst case scenario, stocks with 51 cent to dollar wide spreads. On average, according to the BAT study, we would get filled 38 cents away from mid-price. Right? That means for every 100 shares we trade, we lose $38 per 100 shares. We take a $38 loss per 100 shares on average just to enter the trade. If we do 10 trades a week, right, buy and sell, 100 shares for each trade, in a stock that has a bid-ask spread of 51 cents to $1, on average, we are taking a $40,000 loss just to enter our trades for the year. That is horrific. Even if we're just doing 1 trade a week, just 1 trade a week in stocks that have 51 cent to $1 wide bid-ask spreads, just 1 trade a week, that's still $4,000 we are willingly taking as a loss just to enter 1 trade a week. That should be some pretty heavy stuff. So when we look at this, it's pretty plain to me that the first 2 rows are actually not so bad. The first 2 rows, to me, are just part of doing business. Getting filled 1.5 cents away from mid-price or better is just part of doing business. It's overhead. But once we get to the 8 cent wide to dollar wide, once we get to these 4 rows, 8 cents to 15 cents, 16 cents to 30 cents, 31 cents to 50 cents, 51 cents to $1. Once we get to those bid-ask spreads, it becomes nasty. It becomes really, really ugly. And we are willingly taking substantial losses just to enter the trade. Do you really want to invest in a stock so badly where you are willingly taking a substantial loss just to execute the order? I don't think so. So the rule of thumb is our sweet zone. Anything less than anything with a 7 cent wide bid-ask spread or less is something we can trade. Anything with a bid-ask spread greater than 7 cents wide, we cannot trade. The reason we can't trade it is because we are willingly taking a substantial loss just to enter the trade. And again, there are only so many things in the stock market that we can control. This is one of them, and we don't want to take a loss just to enter the order. We want to always put as many of the odds on our side as we can, and entering a position in a stock that has a greater than 8 cent wide bid-ask spread is not giving ourselves the best chance to succeed. So again, what is our rule for the bid-ask spread of stocks? Remember again, the goal here is to save you money. If you are doing anything in 8 cents or beyond, you're losing money easily just to enter the trade. God forbid the trade went against you. You're losing money just to enter it. So again, what is our rule? Anything wider than 7 cents wide bid-ask spread is too wide. So let's do a little bit of a quiz here, shall we? So Facebook, here is the bid-ask spread today for Facebook. Penny wide. Can we trade it? Yes, we can. All right, what's next here? Apple. Apple, here's the bid-ask spread today in Apple. Penny wide. Can we trade it? Yes, we can. What's next? Clicking buttons. What's next? Amazon. Here is the bid-ask spread today in Amazon. It looks to be about 40 cents. It looks to be about 40 cents. Now, I don't want to go back in the slides, but 40 cents on average for every 100 shares, we're paying $14 of a loss just to enter the trade. This is clearly a bid-ask spread over 8 cents wide. Amazon, should we trade the stock? Surprisingly, no, we should not. We're taking a big loss just to enter the trade. How about something like Google? Google, we already showed this, 50 cents wide on the bid-ask spread. That's clearly over 7 cents wide, we should not be entering a trade in Google because, again, we're going to have to give up some serious money just to enter the trade. Now, again, I know you guys are probably saying, well, Google's a great company. Amazon's a great company. There are much better ways, which I'll show in other videos, there are much better ways to get exposure to Amazon and Google that don't require you to take an immediate loss just to enter the trade. Last one. SPY, the S&P 500 Index ETF, penny wide. Can we trade it? Absolutely. So what are our takeaways, guys? The bid-ask spread, again, the goal is to save you money. The goal is there are only so many things you can control in the stock market. You can control not having to take a major loss just to enter a position. So what are the takeaways? Again, the bid is the most someone is willing to pay, and the ask is the least someone is willing to sell for. Pretty simple. And the width of the bid-ask spread, it determines the amount of competition for shares. The tighter the bid-ask spread, the more competition there is for those shares. Competition is good, and the better prices we end up getting. And we do not want to ever trade any stocks whose bid-ask spreads are wider than 7 cents wide because it is too expensive over the long run and costs too much money just to enter the position. Again, guys, there are only so many things in the stock market that we can control. Having to enter a position where we take an immediate loss just to enter the position is something we can control and is something we should avoid at all costs. So again, guys, I know some of the information in that video might have been a little bit controversial, right? We recommended not buying or selling stocks like Amazon or Google. The reality is those stocks are mostly held by institutions. And institutions are allowed to trade completely different markets than you and I are allowed to trade. They're allowed to trade in something called dark pools. Dark pools don't worry about the bid-ask spread that you or I see. So Amazon and Google, while they're great stocks, while their stocks go up every single day, I recommend do not trade them because, again, you're going to have to pay a substantial amount of money and you're going to have to take a substantial loss just to enter the trade, and you don't want to do that. Remember, guys, in the stock market, there are only so many things that you can control. One of the things you can control is looking at a bid-ask spread and knowing if it's a stock you can buy or you can't. And from now on, if a bid-ask spread of a stock is greater than 7 cents, you know you have to walk away because you cannot afford to take such a substantial loss just to enter the position. Thanks for tuning in. If you guys have any questions or any comments, hit me up in the comments below. I'll see you guys in the next video.